learning outcomes. After watching this video, you will be able to understand what parts of an academic paper are relevant for trading strategy. You will also understand how to comprehend the relevant part of an academic paper. Welcome to this module on trading strategies. I am assuming that by now you are familiar with basic accounting concepts. You know some market terminologies, like what do you mean by shorting a stock. You know some basics about spot and derivative markets, futures and options. Not that you need to know all these in detail for actual trading, but understanding of basic terms will help. So with this assumption I am going to proceed. Now we are going to start now with how to read an academic paper. You may be wondering, why do you need to know about reading an academic paper in a trading strategy course? The answer is, source of our ideas, source of trading ideas is going to come from academic papers. Why are we doing this? This is because there is a wealth of ideas which are there in academic papers which have not been exploited by market participants. People do value investing, people do growth investing, people do technical analysis, people do nowadays text mining, lot of things. But there are low hanging fruits which are available, which academicians have published. This is there in the public domain. You need not have some private information, but these ideas haven't been fully exploited by market participants. By undergoing this course, you will know which are those ideas are. That's the first point. Second, you will also learn to think in those lines and improvise on those strategies. You can create your own strategies based on the ideas which come from these papers. Third, the rigor which is involved in these academic papers is so high that it's very close to causal. Now what do you mean by causal? Two variables moving together does not necessarily mean that one is causing another. All of us understand that, right? But in these academic papers, these authors try to show that what they are claiming, the relationship between two or more variables, is as close to causal as possible. Although perfectly, no one can say that anything is causal. So that is why the replicability of these ideas, the chance that these ideas work, is much higher than a normal strategy that comes from some data mining exercise. What do I mean by data mining exercise? So if you are good at programming, take past data, try 1,000 types of different type of strategies. A simple strategy, any stock which fell 5% the previous day or some X% the previous day, you will buy. This could be one simple strategy. Or something which went up 1% previous week, you will buy or sell, whatever. So if you try thousands of such strategies, purely because of chance, that you will find that some strategies work. Now if you start putting your money in those strategies, you may be in for disaster. Whereas strategies that come from academic papers, based on academic research, these are strategies which have been devised by scholars, experts in these areas, and hence these are not pure data mining exercise. There is an economic logic as to why these strategies work or why they don't work. And the author also defines the circumstances under which these strategies work. Now does that mean that you can always make money? We have reminded you right at the beginning itself. This course does not guarantee that you just undergo this course, you go trade tomorrow and you start making money. No, that's not guaranteed. But then, what can we say with high level of confidence that these strategies work better than most of the data mining exercises? And more importantly, this way of thinking that you will get from these papers, that's going to help you devise your own strategies. And the chances of success of those strategies even higher. Because there you will combine your practical experience with this rigor, that will make a very good combination. So let me re-emphasize again, don't think that you just undergo this course and from next day you will start minting money. That's not going to happen. May happen for some of you, but that's not our purpose. Our purpose is the learners, the students who learn these strategies should be able to apply and also improvise, and more importantly inculcate this rigorous way of thinking about trading strategies. These are trading strategies which have economic intuition. There is some reason why these strategies work. So that's the purpose of this course. Now how are we going to go through this module? So let me tell you what are we going to do in the next couple of hours. Of course, you have the facility of pausing at any time. That's the beauty of this medium. But what we are going to do is that first we are going to give you an outline as to how an academic paper is structured. It's very important. There are large number of strategies available out there in the public domain. So obviously in this limited time I won't be able to cover all strategies, or I'll be able to cover very few of them. But then I will point out sources where you can read about more strategies. Now one major challenge that is going to come here is that all these papers tend to be highly technical. What do I mean by technical? These papers are written with scholarly audience in mind. These papers are not written for general audience. So the writer sort of assumes that reader has some level of understanding, and more importantly writer also assumes that the reader is up to date with the existing literature on that area. So if you pick up any paper, you will see large number of citations of other papers. Now does it mean that for trading you will have to go through all those papers, take a 5-year accounting course, take a 5-year finance course, and learn mathematics, statistics? The good news is no. So, and that is what the purpose of this module is. What we are going to do is that in this dense jungle of an academic paper, we will try to pick up exactly those parts which are required for understanding the trading strategy that comes out of the paper and implementing it, and also understanding how the strategy has performed in the past. Now that's the purpose of this module. Okay, so let's start. So instead of picking some paper which we are not going to use, let's start with the paper that we will use in this course. So this is a paper by Joseph Piotrowski. This paper is published. I repeat, published. This is in the public domain. So there is no secret recipe out there which you will not be able to get. This is fully publicly available. It's a paper by Piotrowski about value investing. So you can see on the screen the exact title of the paper. You can also see where the link that you can see where the paper is available publicly. So this is published in Journal of Accounting Research, which is a top journal in the area of accounting. Now the idea of paper is very simple. You would have heard about value investing, right? I'm sure most, if you're interested in trading, you would have already heard about value investing, or you would have heard about Warren Buffett for sure. What these people do? Value investors generally pick up stocks which are neglected by the markets and buy them at a time when they are valued very, very low when compared to their intrinsic price, and then hope that these stocks, the market will realize sometime that these were good stocks, and then the prices go up, and that's how they make money. Now the question comes, why markets neglect these stocks? How do you identify these stocks? And how do you trade these stocks? Now what Piotrowski's paper does is the paper gives you an algorithm to identify a subset of stocks within this value stocks which are likely to outperform others. That's what this paper does. Now why don't you pick up all value stocks and just buy and hold? Can you make money? Is a question. You have to ask yourself, if that were so easy, if you can just pick up stocks which are valued low, then why are there only so few successful value investors? All of us should have become value investors, right? Just take a list of stocks, look at stocks which are valued very low. I'll come to this point, that how do you see that a stock is valued low or high? Assume that there is a way of finding it out. Then just pick up those stocks which are valued very low and just buy them and hold, and you make money. You don't need to do, you can party for rest of your life if it were so simple. As you would guess, it's not that simple. Financial economists have pointed out, including Nobel laureates like Eugene Fama and others, the reason why these stocks are valued low is because many of them are on the verge of bankruptcy. There are serious problems for these stocks. Some of them may have liquidity constraints, some of them may be on the verge of default, some of them may be making losses, and so on and so forth. And some of them may have governance problems. The numbers may be saying something, accounting numbers may be projecting a rosy picture, but there may be some scandal going on. We have had numerous instances like this. Some of them may be taking risks which the market, which a lot of people may not realize. So that may be one of the reasons why these stocks are valued low. Now if you buy all these stocks, and if you tend to buy such stocks just because they are valued low, you may end up losing all your money. And that's precisely why we have very few Warren Buffetts. We don't have too many of them. So now what Petrosky does is, within this universe of low value stocks, how do you pick up those stocks which are likely to be potential winners? That's the question that Petrosky tries to answer. And more importantly, he gives you a specific formula. Now if I can tell you, right, this is a skill. If I tell you it's a skill, then there is no answer as to how do you acquire that skill. This is not like painting and drawing and music and all that. Petrosky gives you a specific formula. Does that mean that you just have to know that formula and there is no scope for skill? No, not at all. That's not what I mean. What I mean is, by understanding this Petrosky's paper, you will get a specific formula to start with. You will get a screen, basic screen, and from there you can build on. So this is a score, the Petrosky score, which is called F score. Tells you whether you have to buy or sell a stock, right? So that's the starting point. Now what we are going to do in this module is take you through different sections of this of a paper. Of course we are going to use Petrosky's paper. Why to burden you with another paper which anyway we are not going to use? And tell you, suppose you are given a paper, how do you locate that particular area or part of the paper that contains what you want, the meat of the paper, so to speak. A paper typically has some 60 to 70 pages. You will have around typically 30 pages of text, some 20 pages of tables and some 5-6 graphs. That's how you will see in a paper. As I have told you before, the author's purpose is to publish this paper in a peer-reviewed journal. So there are referees who look at this paper, ask questions. They say that they ask the author to explain how this works. They come out with alternative explanations. The author has to show that the paper is robust to these kind of alternative explanations, and so on and so forth. What I mean is there are a lot of parts of the paper which are not essential from a trading point of view. Of course, I encourage you to read the paper fully, understand the paper fully. Some of you may get interested in pursuing a PhD. That's an unintended consequence. That's great. But purely from a trading point of view, you do not need to read the entire paper. So first let me tell you how a paper is structured. The first part of the paper, after the title, you will have something called as abstract. Now abstract, what it contains? Basically the entire paper is summarized in about 150 to 200 words, sometimes less than 100 words. Abstract will tell you the main question of the paper, what the paper does, and what results the authors get. So these are all summarized briefly. So if you just read the abstract, unless you have a understanding of the literature, unless you have an idea of what the paper is trying to do, you may not understand much. You can just read the abstract, it's not too taxing, it's just 100, 200 words as I've told you before. But I don't think you will get a full sense of what's going on by just reading the abstract. Once you move on, the next 4 to 5 pages of the paper is the introduction. Now, what the introduction does, this section, if you have some background in the literature, if you read the introduction, you will understand the entire paper. Introduction, what introduction does is gives you a motivation for the paper, why the authors actually started this inquiry, what is the background, what has happened in the past, and how authors contribute to the literature, and of course their main results. They also briefly talk about data sources. They will also talk about what methodology they employ. That's very important. As I've told you, the referee usually asks for robustness tests. The authors have to show that their results are robust to alternative explanations. So, a lot of these things are briefly explained in the introduction. Now, the question is, purely from a trading point of view, do you need to read the introduction or not? I encourage you to read the introduction. And those parts which are technical, where you have these statistical terminologies, where there is a lot of math, you may just ignore. What you need to understand is that what is the trading strategy that is being employed here, and from where do you get the data to replicate these trading strategies. If you get a broad idea of this and what are the kind of returns this trading strategy has generated in the past, and also what is the economic reason why this trading strategy works. If you understand this much, once after reading the introduction, I think you are in good shape. After this, you have institutional background. Now, institutional background basically describes the institutional setup of the country from which the authors use the data. Most of the papers are obviously from the United States, but there are papers where data from other countries are also used. Now, one important check that you have to do here is A, are the authors using some proprietary data? Now, suppose that sometimes what happens is authors go to some government agency or a central bank and get some data. Now, if this trading strategy depends on having access to this data, you can just forget that paper. It may not be possible for an individual investor to get this kind of data, whereas academic researchers will have access. So, you should ensure that the trading strategy is not a result of a typical institutional feature which is applicable to a particular country. Then the trading strategy also, of course, applies to only that country. If that institutional structure is not available elsewhere, then you can't do anything. Suppose, I will give you an example. Suppose the trading strategy involves shorting, and the country where you want to use this strategy, shorting is not allowed. Then there is no point in going through that paper. Because if shorting is not allowed, there is no way you can replicate the strategy in the country where you want to trade. So, from that point of view, you have to read institutional structure. Institutional structure typically is not very, very technical. It explains the market structure in that country in brief. So, it is not very dense. You can glance through the structure. Then the next part usually is about data sources. This is very, very important. I've already given you a hint. When you read the institutional structure itself, you should have an idea that whether this is something which is typical to a particular country. Data sources, as I've told before, you should look whether the authors are using some proprietary data or it's a public data. If it's proprietary data, stop, forget that paper. You only look at papers where data source is public, anyone can access. By public, I don't mean free. Sometimes you may have to pay, but since you are going to trade, and if you are confident about the strategy, it's not a bad idea to even access paid data, but most of the data sources are free, are freely available. Once you understand the data source, the author also describes how he arranges data, how he or she organizes data, all that you can have a look at and understand. Then the next part is the most important part. Once you get used to reading papers, you can actually start from there. If you actually understand the abstract fully, you can just get into this next part that I am going to describe. This is about trading algorithm. Now that is why we are interested in the paper. From a trading point of view, our interest is more in this algorithm rather than the knowledge that is coming from the paper. Of course, we are interested in knowledge, but the primary interest is this algorithm. This is the meat of the paper that a trader has to understand if you have to implement. So what does this section do? Here the author describes the exact formula that he uses for trading. So here a prospective trader should go through this line by line, word by word, understand this fully. What do you mean by understand this fully? You should be able to generate this data and generate this, code this formula using whatever software that you are comfortable with and come out with the output that the author comes out with. In other words, you should be able to replicate the formula. That's the level of comfort that one should have. Now, how do you get it? So, what we will do in this course is that for some papers, we will take you through these formulae in detail, step by step. We will tell you what are the components of this of a formula, where do you get the data from. We will actually show an illustration with the actual company and show you how to create these kind of scores. We will also show how do you trade, and finally we will also present the results that the author has obtained. And since we are in India, so what we will do is, if you apply the same strategy on Indian stocks, then what would have been your results? Even that we will show for the kind of strategies. What we encourage you to do is, once that is done, of course the easy way is to just try this on stocks and see whether it works. As I warned you before, it may not work in the same form where it has worked 20 years before. You need to improvise. So the first thing is, you should first try whether you can replicate on your own, and then try to apply this on a mock portfolio. And once you are confident that this works, and then only you should try trading, and based on the insights that you obtain, you should try to generalize. That's our advice. Now coming back to the sections of the paper. Paper doesn't stop at there. This once your trading strategy algorithm is done, then the author gets into the next part of the paper, which is hypothesis. What does he do here? Here the author tries to explain different hypotheses as to why this trading strategy works, and why he also presents tension in the hypothesis. There will be reasons why this trading strategy works, there will be reasons why it should not work, and then he shows the purpose of the paper is to empirically test which of the hypothesis holds. As an aside, please remember, you can never accept a hypothesis, you can only reject something. And author, the way the approach is, author rejects all other explanations and then comes to a conclusion that possibly this must be the reason why it works. Now again, this is more for an academic audience. It's nice to know. I want to repeat this once again. I am not discouraging you from reading the paper. Don't think that after this module, don't think that you should not read the entire paper. No, that's not the purpose. It's good. Somebody who reads and understands the entire paper will do better than someone who reads only a part of it. But then, the purpose of this module is to tell you that you need not understand the entire paper, purely from a trading point of view. You just have to understand the trading strategy that comes out of the paper, how to implement it, data sources, and the expected results, and the ways of back testing it. That's the purpose of this module. So purely from that utilitarian point of view, you can try to ignore this hypothesis part. You will not lose much. The next part is about empirical strategy. The empirical strategy will tell you what are the statistical methods, tools and techniques the authors use to prove that whatever they are trying to establish actually happens in practice. So this part is highly technical. Let me warn you, unless you are trained in econometrics, unless you are trained in, have some background in mathematics and statistics, it may be difficult to interpret these things. For example, you may suddenly find a sentence that we use regression discontinuity technique. Now what is this regression discontinuity? So if you try understanding, it may take a lot of time, which may not be required purely from a trading point of view. So this empirical strategy section can be safely ignored from a purely trading point of view. Of course, it's great to learn, but not required from a trading point of view. Now coming back, the next section is important. This is about results. Here the authors show what has been the performance of this strategy. This is very, very important. Now here is the difference between an academic exercise and a data mining exercise. Now what happens in a data mining exercise, the purpose of each test there in a pure data mining exercise is to show that something actually works. So authors, there people try like 10 tests and pick up the one that works and say that this works. If you have seen a typical technical analysis kind of a show where people say that some particular pattern works, Head and Shoulders for example works. If you don't know Head and Shoulders, nice, you can think that it's a shampoo brand and forget it. But then how do they prove? They pick some instance where it works. So they say that 6 months back on a particular stock, Head and Shoulders pattern emerged and it worked, and that's the money it made, the strategy made. That's why it's an amazing strategy. Now again the Head and Shoulder pattern has emerged, and hence you are likely to make money if you follow this particular strategy. This is a typical data mining kind of an approach. The approach that academic papers take is not this. The author attempts to reject a particular hypothesis, continuously tries to show that a particular trading strategy does not work. And if he fails to show that it does not work, then he says there is likelihood that this may work. He will never ever conclude with certainty that a particular strategy will always work. After a careful attempt to reject the possibility that the strategy does not work, then he concludes that probably this works. It's a very different approach. Now coming back to Head and Shoulders. Now if you give it to a careful researcher with Head and Shoulders, what will he do? He will take data of 20 years or whatever 30, 40, 50 years the data is available for. He will look at all instances where this strategy has, this pattern has emerged. He will look at all. This is very important. He will not pick and choose. Sometime this worked, 20 years back this strategy, this shape emerged and it worked. He will not do that. What a careful researcher will do, will look at all instances where this shape emerged, and then out of these instances, what has been the result? How many times you made money? How many times you lost money? How many times nothing has happened? Suppose this strategy has worked, let's say, has on an average given you some 5% return. Now the author compares this to what would have happened if you have just randomly traded without this strategy being there. Suppose you call some monkeys and ask them to throw darts on a stock, what would have been your return? You can assume market return as that you will get from a passive trading strategy that you get from an index. as a benchmark, and they compare whether this strategy of buying whenever this particular shape emerges outperforms this kind of passive investing. The approach here is to attempt to reject something, and despite your best efforts, if you cannot reject, then you sort of say that maybe this is working. So that's the approach these papers will take. So as I've said, this head and shoulders, they compare it with market returns, and mind you, most of the time with these kind of strategies, you will find that those strategies don't work in practice. Just think of this way. So if you had just looked at some shape and made money, everyone would have made money, right? That's not that easy. So you should be very, very careful while looking at these self-selected examples. Whenever you hear of some tip or a trading strategy, you should always keep this in mind. The approach that you're following, is it trying to accept something or reject something? So from that point of view, reading this result section is very important. What this result section will do is that initially it will show you the main result. The authors describe the main result, and then they show you a series of tests which are performed where the authors attempt to reject this particular hypothesis that they have, and they fail to reject it. That is why they claim that there is a paper, there is an idea which needs to be, which can be exploited. They also attempt to show that, what if it's some luck because of which this has worked. They perform tests to sort of disprove that. And these are called robustness tests. Now what are these robustness tests? Let me give you some examples. It's quite possible that out of a 20-year period, you had a 1 or 2 year period which was extraordinary. Let's take financial crisis. You have a strategy where you short banks or any financial institution, and you choose a sample period between, let's say, 2005 and 2015 or 2012. And you find that a strategy has worked on an average, and it has given you annualized, say, 20% return. Amazing. But then it's quite possible that all your returns are concentrated between 2007 and 2009 or 2008. What does this mean? That means that this strategy has worked only during financial crisis. Now if financial crisis is going to persist forever, then it's fine. But during normal times it may not work. And more importantly, when the economy booms, this may go the other way. That's more important. Suppose you have a strategy of going short on value stocks or distressed stocks. When the economy is in a bad shape, or when it is entering a crisis, entering a recession, this strategy may do very well. But when the recovery starts, these are the very stocks which fell 90%, 95% during a crisis may recover like 3 times, 4 times in no time. Remember those who shorted Citi at very low levels. They would have lost their shirts when the stock recovered. So an average result over 20 years will not tell you all these things. So the subsequent tests which authors perform, they try to control for all these possible explanations. So in technical terms, they have time fixed effects, which basically control for impact of time. In other words, they are trying to show that by employing these, they are trying to show that these results are not driven by a particular period, particular year, particular month. Then they also show that these are not driven by few stocks. It's quite possible that your portfolio consists of 100 stocks, but 2 or 3 of them suddenly moved abnormally because of some reason, and your entire portfolio makes positive return because of them. Now this is not a replicable situation because such 2-3 stocks may not exist next time. Please understand, our purpose is not just understanding the paper, our purpose is to see whether we can utilize the strategy elsewhere. So they use these kind of fixed effects like at firm level to rule out that this is not driven by a particular firm or a particular group of firms. What they also do is that they subdivide the sample as a further robustness. They divide it into some smaller time intervals, and they show that the strategy works in each time interval. More importantly, each time interval the economic situation may be very different. They also show that this is not an impact of some alternative explanation, something else going on which caused this. So all these tests are designed to rule out these kind of alternative explanations which could have caused these results, and hence made these results not replicable in another situation. So from that point of view, at least the first paper that you are going to read, try to see at least the purpose of these tables. You may not understand exactly what the underlying econometrics is, but at least before this result section, each subsection in that section, the author in the first 3-4 lines, author clearly mentions why this particular test is done. If you understand that, and the fact that the paper is published, has gone through peer review process, you can be reasonably sure that very, very low hanging kind of objections the authors would have taken care of. Does this mean that the paper is perfect? Does this mean that there is no other alternative explanation possible? Does this mean that the strategy always works? No, I have told you right at the beginning. We are not giving you lollipops here, a low hanging fruit you just pick up and you start making money from tomorrow. That's not what is going to happen. But then I can tell you with a lot of confidence that the rigor that these papers have is unmatched. This is far, far more reliable and replicable than a result of a pure data mining exercise. So once you go through this result section, so how much attention you have to pay? Now let's recap a bit. I told you there is an abstract, there is an introduction, then you have institutional background, then you have data, then you have algorithm, trading algorithm, then you have empirical strategy, then you have results, and finally there is conclusion. Now before going to conclusion, in some papers you will also have a theory section. Now from a trading point of view you can just ignore it completely. Now it's a very important part. I am not trying to belittle that section. Basically here the authors try to show that how their paper contributes to the existing theory of in economics, corporate finance, accounting, whichever area that paper deals with, but purely from a trading point of view it's not required. Now is it totally useless to understand theory? No, not at all. But the point is this section is extremely dense, highly mathematical. You will have theorems, you will have proofs. So if you have a liking for these things, please go ahead. A positive side effect of understanding this section is that this will help you to improvise. Understanding theory will help you to improvise, but then if you don't understand, it's fine. You can still implement the strategy as it is. So now coming back to the last part of the paper, you will have conclusion. So conclusion, here again authors summarize their results and show that how their results contribute to the literature, what improvements can be done. Now that is also, some of the papers give you some clues as to what further work can be done. You may just start from there. If it's a recent paper, you can be assured that nobody would have done that also. So you can from that point of view, this conclusion is important. It's typically 1.5 pages, sometimes less than that. And with that the paper ends. Then you have citations and then you have tables. Now when you read, one thing that I forgot to tell you, when you read a data section, as you read the data section, also see the relevant table. First 2-3 tables will summarize data sources, variable definitions and all that. So read them in parallel. Also when you read the result section, try to read, because the way the paper is organized is first 30 pages, as I've told you, first 30 pages of text, 25-30 pages of text, citations 3-4 pages, then tables. So text corresponding to a table and the table are separated, they are not put together. So when you read a particular section on results, when a particular result, I strongly encourage you to also look at tables simultaneously. Then the understanding will be better. When the author says this strategy leads to 3% return annualized, just look at the table and verify for yourself, do you find that 3% somewhere? That will help understanding better. So you should read them together. So once this table part, then you will have pictures. Pictures basically convey, they help improve understanding, and that's how a paper is typically structured. So now what we'll do, now that you understand how a paper looks like, I encourage you to look at this. If you see the slide, it will show you, it is showing you where this Petrosky paper is available. I strongly encourage you to download this paper, maybe print it out or use your device and just verify for yourself whether you find these sections. If you find, or any other trading strategies paper, if you find anything which you cannot understand, you can write to us. We will answer your questions. And if you find any new section which I have not told, because see, there is no law, this is not a legal format. This is not a format determined by law. You may have, depending on the context of the paper, you may have other sections as well, or there may be papers which may not have any section. As I have told you, theory for example, most papers don't have theory, some papers may have it. Some papers may combine 2 or more sections. For example, hypothesis and empirical strategy may be combined. That's possible. Now that you understand the structure of a paper, I can assure you that you will not get frightened by the technicalities involved in a paper. Before proceeding further on this video, I strongly encourage you to download this Petrosky paper or any other paper and just try to see yourself. As I've said before, there could be change in the structure, but more important for you is to understand where this trading strategy section or the algorithm section is and start trying to replicate. Another thing that a prerequisite that for this kind of course is that you must be familiar with some kind of a statistical package to analyze data. It could be as straightforward as an Excel, or if you know programming, that's even better. Not essential again, you can do a lot of your work in Excel itself, but I strongly encourage that you brush up your basics in any of these packages so that you can download data and start testing them. That's very important. Remember, the key is to have this mindset that you are making an attempt to reject a hypothesis and not to come out with something. Because ultimately you are going to put your hard earned money, yours or your investors, into these strategies. So it's no fun in getting high results on paper, and when you actually go and practice, finding something else. And that's possible if the testing is done in this kind of with this attitude to find some results. You should always try to reject it, and I'm confident that on an average you will do well. So with this we will conclude this section on how to read a paper. Now how do we go forward from here? In the next part I will pick up Petrosky's paper and take you through the abstract line by line. Now the purpose of this, of course I can't take you through the entire paper line by line, that itself will be 12 hours or 15 hours. And as I've told you, that's not needed also, but abstract I'll take you through line by line so that you understand how to read the abstract and what does this paper do. And then from there I'm going to jump straight away into the algorithm section and tell you exactly how Petrosky score works. Once you know scoring, what I'll do is I'll explain how do you actually trade. I'll also explain what are the kind of results that Petrosky has obtained, and then I will also show you, by taking up real examples of a particular company from India, that how do you get these scores. And you can, in other countries what will happen is way these items are described in balance sheet, the ordering may be different, but the broad idea should work everywhere. So that's the plan going forward. So I urge you strongly, I encourage you to just go through this Petrosky paper, at least broadly, before you start the next part on abstract and also the scoring of strategies. Learning outcomes. After watching this video, you will be able to read and understand an abstract of an academic paper. Welcome back. Welcome to this section on reading an academic paper. As I've told you in the previous section, I'm going to take you through a paper which is a basis of one of the celebrated trading strategies on value investing. This paper is written by Joseph Petrosky, and the paper is published in Journal of Accounting Research. By the way, Journal of Accounting Research is a top journal in accounting. So this paper is about building trading strategy which based on value investing philosophy. You would have heard about Warren Buffett and many other investors who practice value investing. What this paper does is that it creates a formula, for value investing. You look at a bunch of variables in a financial statement of a company. Using these variables, you create a number, and this number is called F score. And using this F score, you develop a trading strategy. That's the broad idea of this paper. As I've told you, the purpose of any academic paper is to contribute to knowledge. So the author explains why this strategy works, how does it contribute to our understanding of markets, and so on and so forth. But as a trader, we are less interested in that part and more interested in the trading strategy part of it. Of course, it doesn't mean that I'm discouraging you from reading the paper. You're most welcome to read the entire paper. You can send us questions if you have. But then the most important part for us is understanding the strategy itself. As I've told you, a paper has many sections. In the last module I told you it starts with an abstract, goes to introduction, then you have institutional background, results, empirical strategies, and so on and so forth. So let me start with this paper and give you an introduction as to what each section contains. Let me start with the abstract. As I've told you before, abstract ranges from 100 to 200 words and summarizes the entire paper in brief. Let's see an example using this paper. See the first sentence of this abstract that you can see on your screen. This paper examines whether a simple accounting based fundamental analysis strategy. Let me stop here. What is this paper examining? Simple accounting based. This is important. This is accounting based. I told you before that you need not have any special proprietary data to implement these strategies. This is simple accounting based information. This is all available in the public domain. You don't need to know anyone. You don't need to know the management. You don't need to have inside information. None of those. All that you require is accounting information. That's a big plus as far as this trading strategy is concerned. The next key word is fundamental analysis. Now, what is this fundamental analysis? Fundamental analysis is understanding a company through its publicly disclosed information. The idea here is that if you analyze company's balance sheet, company's revenue statements, the profit and loss account, and disclosures made by the management, you will be able to get insights which are not yet incorporated in price. We have this concept of efficient market which a lot of academicians use, where the idea is every information is instantly priced in. If that is the case, then fundamental analysis is of no use. But people who believe in fundamental analysis think that if you really understand the nitty-gritties of a company through its accounting statements and the statements made by the management, there is money to be made. You will have insights which are not known, you will get insights which are not priced in by the market. What do I mean by this? You will be able to identify whether a company is overpriced or underpriced. So that's the meaning of fundamental analysis. We'll talk more about this. When I talk to you about this trading strategy, you will understand it even better. Let's continue with this abstract. What it says? When I apply to a broad portfolio of high book to market firms, let me pause once again. When I apply to a broad portfolio, so broad portfolio is important. All these strategies work on a broad portfolio. It's not about individual stock. Nobody is making a claim that on every particular stock, on every day, you can make money. It's impossible. There are large number of factors that impact a stock price. That's not possible. But if you have a broad portfolio of stocks, then these strategies work. And then what is the next operative word? High book to market firms. What are these high book to market firms? In the previous module, you already learned the concept of book value and market value. So book value is nothing but the value of a firm as recorded in its books. Suppose you buy a property at 100,000 and you depreciate it at the rate of 20% every year. First year the value of the property, the book value of the property is 100,000. Second year it will be 80,000. So if your company has only that asset, then the value of your company and suppose there are no liabilities will be 100,000 in the first year and 80,000 in the second year. That's the book value. And suppose you have 100,000 shares, book value per share will be 1. What about market value? Market value is the price of your shares times number of shares. Suppose for the same company, the value price of per share is 2. So if you multiply 2 with number of shares, which is 100,000, the value of the firm becomes 200. Market value of the firm becomes 200,000. So book to market value in this case is 1 divided by 2, which is half. So this strategy applies to a broad portfolio of firms which are high book to market value. This high book to market is very, very crucial in this strategy. So so this ratio half, higher this ratio, so that the firms which have high book to market ratios are the firms on which this strategy works. That's what the author is trying to say. Now, let's move on further. The author says, can shift the distribution of returns earned by an investor. Now, I have told you there are a lot of parts in the paper which are not required from a trading point of view. Now, this is for academic audience. If your purpose is just trading, you can safely ignore this part. Can shift the distribution of returns earned by an investor. Those of you who are interested in understanding this, if you read the paper, you will get an idea, you can write to us. But from a purely trading point of view, you can ignore this part. Now, this is the first sentence. The sentences in abstract, let me warn you, tend to be very long. The reason is they want to club a lot of information in this 100, 200 words. Let me move on to the next sentence. Petrosky says, I show that mean return earned by a high book to market investor. So I already told you what high book to market is. If there are, let's say, 3 firms with one having 0.8, one having 0.6, one having 0.4, high book to market, the highest is a firm with 0.8. Now, in the paper, we'll really explain what are the characteristics of these high book to market firms are. But it's time you can pause and think, what are these high book to market firms? Essentially, these are firms whose assets are not valued as much as other firms. In other words, for a particular book value, the market value is low. Remember, The book value is in the numerator and market value is in the denominator. So these are our value stocks. So the strategy focuses on value stocks. We are going to give you more examples as we proceed. So Petrosky says, I show that mean return earned by a high book to market investor can be increased by at least 7.5% annually through the selection of financially strong high BM firms. This is important. Number of people have shown that the strategy of buying high book to market stocks makes money. Value stocks make money. People ignore these stocks, but if you buy all these value stocks and hold on for 5-10 years, people have shown that they make money. Petrosky says, if you use this, his formula, if you use his trading strategy, you can increase returns earned by a value investor who buys all high book to market firms by 7.5% per annum. 7.5% per annum is huge. And the operative word is financially strong high BM firms. Now this is where fundamental analysis comes in. How do you know a particular firm is financially strong? You will learn about the strength of a firm through its accounting information. You just need accounting information for this strategy. You do not need anything which is not there in the public domain. So using accounting information, you identify financially strong high book to market firms and then trade using this strategy, which Petrosky has outlined in this paper, and your returns are, at least in the past, the data that Petrosky analyzes, your returns are 7.5% per annum higher when compared to a strategy where you buy all high book to market firms. Let's move on. Next he says, while the entire distribution of realized return is shifted to the right. Again I said, we will not bother about distribution of returns here. Next sentence. In addition, an investment strategy that buys expected winners. Now, how do you know which firms are expected winners? Again, fundamental analysis, going back to accounting statements, identifying strong high book to market firms. If you do that, you will come out with expected winners. And shorts expected losers. So you create a trading strategy where you go long on expected winners and you short expected losers. You are already aware about longs and shorts. Longs is buying, shorts is selling without buying. You borrow a stock and sell it. A previous module has covered shorting in detail. Those of you who have forgotten can refer to that module. So the trading strategy of Petrosky is, look at the accounting statements. First of all, create the universe of these high BM stocks. Look at the accounting statements. From the accounting statements, identify potential winners using his formula. Identify potential losers. Go long on the winners. Go short on the losers and hold on for a particular period of time. If you do that, Petrosky says, I move on in the next sentence of the abstract where he says, investment strategy that buys expected winners and shorts expected losers generates a 23% annualized return between 1976 and 96. This is huge. The best of the best investors have earned around 20 to 24% annualized returns throughout their career. You can just take an Excel sheet and see, if you start with the $100 and if it compounds at 23-24% for 20 years, how much it's going to be. This is huge. Now please, mind you, this 23% is based on the past numbers. It is not that every 20 years you are going to make 23%. There will be a number of tests that we are going to do to test whether this is robust. But this is what Petrosky has found. Between 1976 and 1996, if you had used this strategy, you would have made 23% annualized return. Then he says, and the strategy appears to be robust across time and to controls for alternative investment strategies. Now this is the beauty of an academic paper. Number of times people just do data mining and come out with some kind of a number. In order to show that this is not a mere data mining exercise, Petrosky shows that these results hold even when you change the time period, even when you control for other kinds of explanations as well. Then he says, within the portfolio of high BM firms, the benefits to financial statement analysis are concentrated in small and medium sized firms, companies with low share turnover, and firms with no analyst following. Now this is very important. Now the question is, if it is so easy, why is this strategy working? Why are others not implementing these strategies? The next sentence gives a partial answer to this. Most of the money to be made here comes from small stocks, stocks which are not covered by analysts, stocks where the trading is very thin. In other words, these are stocks where smart institutional investors cannot enter that easily. That's one of the reasons why this works. Yet, the superior performance is not dependent on purchasing firms with low share prices. This is also important. It is not that you buy penny stocks, you will have to buy penny stocks for this strategy, because penny stocks are risky. We all know that these stocks which are priced very low, $1 or some cents, they easily lose 90% in no time. So this strategy, when we say that these are small stocks, it is not small denomination stocks. These are small firms. These are firms which are not covered by analysts as much. So the point is, this strategy, the results of this strategy are driven by stocks which are not covered by analysts, which are small, and also those with low trading turnover, but not by penny stocks. Petrosky further says, a positive relationship between the sign of the initial historical information and both future firm performance and subsequent quarterly earnings announcement reaction suggests that market initially underreacts to the historical information. Now this is the reason why fundamental analysis works. He gives second reason why it still works. He shows that a positive relationship between sign of the initial historical information and future firm performance. So it's not just that the stocks which are identified as high strong book to market firms here give only high stock returns. He shows these firms actually perform better, their profits increase, their sales increase, their investments increase, their efficiency increases. So this formula is sort of an advanced indicator of how good the firm is going to be, and the market for some reason does not recognize it beforehand. The market underreacts to this kind of information, and that is why there is a scope for a trading strategy. Finally, Petrosky says, in particular, 1/6 of the annual return difference between ex ante strong and weak firms is earned over 4 3-day periods surrounding this quarterly earnings announcement. Again, this is not very critical for us. Basically what he is saying is 1/6 of the annual return difference between strong and weak firms. Mind you, now we have moved on. There are two numbers I told you, one is 7.5%, one is 23%. Now what is this 7.5%? 7.5% is if you have all high book to market firms, trade all high book to market firms, or trade, by trade I mean going long, only those firms identified by Petrosky formula, your returns are likely to be 7.5% higher in the Petrosky subsection when compared to the entire high book to market portfolio. The 23% comes from a strategy where you go long on strong high book to market firms, you go short on weak high book to market firms, and the difference between the two works out to be 23%. Now what Petrosky is saying, 1/6 of this difference comes in a short interval of few days immediately after quarterly earnings announcement. So if you want to know where the maximum impact of this strategy is going to be, is immediately after quarterly earnings are announced. So one needs to be really quick to utilize this strategy, to implement this strategy. Otherwise you would have lost 1/6 of your return. Overall, finally Petrosky says, overall the evidence suggests that the market does not fully incorporate historical financial information into prices in a timely manner. Now this is the important contribution Petrosky makes to the literature. He says markets are not super efficient. They do not instantaneously price in every possible information. There is scope for fundamental analysis. There is scope to understand accounting information in detail. You can make money by such an exercise. There is use to such an exercise, and that's the purpose of this paper. So if you see the abstract, the entire paper has been summarized in about 8 to 10 sentences. When one reads the abstract, one does not get a complete idea about the trading strategy, but you understand the background, you understand the contribution of this paper, and you also understand roughly what the trading strategy is going to be. So it's important that we continue reading further, and read introduction, get into the algorithm part, and also read the main results. So in the next part, I'll take you through the introduction. Learning outcome. After watching this video, you will understand how to implement Petrosky F-score in real life. All right, where are we now? We have understood basics of accounting. We have done a little bit of basics of markets. We have seen how to read a paper, structure of a paper, what part is important for us. We have seen how to pick up that algorithm part, how to understand where the data comes from, and we also picked up this Petrosky paper and actually constructed Petrosky score. That's where we are right now. So we have F score, which is Petrosky score, ranging from 1 to 9. So quickly, it's time you can pause and think about construction of the score. So what are the profitability measures, capital structure measure, and efficiency measures? So 4 plus 3 plus 2, which constitute Petrosky score. You can quickly recap. And now you should be in a position, given a balance sheet, given a firm's details, you should be able to construct Petrosky score for all firms for which you have this data. Of course, you know what the data requirement is. So you need to have profitability information, leverage, sales, so on and so forth. So that's where you are right now. Now, what do you do with this score? Go back to what we said in the abstract. So we said two things. We said a buy and hold strategy which buys these stocks and holds does approximately 7% more than a universe of high BM stocks. In other words, if you just buy all high BM stocks and hold on, if you make X%, here you will do X plus 7%. You would have done. I am not saying you will do. You will do is not right. You may not be able to do. So that disclaimer always applies. Every sentence I say comes with that disclaimer. It's about past and likelihood of things working out in the future, not a certainty of things happening in the future. Coming back, so if you just buy and hold a stock or buy and hold this Petrosky portfolio of stocks which score very high. By the way, high Petrosky score means fundamentally relatively sound companies among these high BM stocks. Low score means fundamentally relatively not so strong companies. Now if you buy these strong companies and hold, you are likely to outperform the universe by 7%. Now what's wrong with just buying and holding? Nothing wrong per se, but what is is there a possibility of you losing money if you just have buys? Yes, there is always a possibility of losing money in stocks, but if you just do a buy and hold strategy, what if the entire market goes down? Petrosky's claim is not that even if the market goes down, these stocks will make money. No, that is not the claim. Underline the word outperform. That's critical here. All that is saying is, if the high BM universe earns X%, this particular portfolio of high F score firms will have done X plus 7. So that X could be negative. What if the entire portfolio does minus 30%? then what Petrosky shows is his portfolio does minus 23%. Can we do better? Yes, that's what Petrosky suggests. What we can do is that we can create a long short portfolio. What is this long short portfolio? Go back to your basics of markets module. Long is buying, short is selling without buying. So when you combine longs and shorts, that becomes a long short portfolio. Now the question is what to long and what to short, or what to buy, what to sell. That's the basic question in trading, right? At the end of the day, the purpose of all this exercise is to come out with stocks to buy and stocks to sell. That's the goal. Now here is where your skill comes. There is no predetermined rule for this. So Petrosky also tries various combinations. So as a starting point, just think about this. A firm which is scoring 9 out of 9. What kind of firm is this? This is a firm with high return on assets. You should be able to tell all the 9 by now. This is a firm which has a positive change in return on assets. This is a firm which has positive cash flows. This is a firm with low accruals. The firm actually has high operating performance. Capital structure is fine. It has not raised equity in the recent past. Leverage is actually going down. Asset turnover is high, and so on and so forth. So this among this, and yet most important point to note, yet such a firm is falling in the category of high book to market firms. See, if you go to the other half, which is low book to market firms, you will find any number of firms satisfying these 9 characteristics. They are good firms. By definition, they are good firms, they satisfy these characteristics, and the valuation is also high. So nothing surprising. You may not be able to, all these may be priced in, so by buying them you may not be able to make money. There is a separate strategy that deals with them. We will talk about it later. But the point is, the firm which is scoring 9 is a firm with all these good qualities, doing well on profitability front, doing well on operational performance front, doing well on capital structure front, and yet finds itself in the universe of high book to market firms. That means market hasn't valued it positively or highly, although the fundamental performance looks decent. Or the more important thing is all those delta characteristics. Please pay some attention on the delta. What those delta characteristics mean? These metrics, all these ROA or cash flow, they are all improving. That's what these characteristics are indicating. So these firms are not only having positive fundamentals, their fundamentals are turning for better. So definitely, firm scoring 9 should be in your list of buys. Now that's easy. Now what about sell? Now using the same argument, what are these firms which score 0? Think of a firm that is scoring 0 on the Petrosky matrix. Now this is a firm with extremely low profitability. They may be losing money. More importantly, profitability is declining, operating performance is declining, and capital structure position is precarious. That is the reason why it gets a score of 0, and it finds itself in high book to market firm category. Now here, market has identified the fundamentals of the firm correctly. Such a firm which has such bad fundamentals, if you will, finding itself in this high book to market universe should not be a surprise. Now you can also think that, consider the dangers of investing in all high book to market firms. If you just pick the universe of all high book to market firms, you will also picking up these stocks which are scoring 0 on Petrosky scale, No, the score of 0 in Petrosky scale itself doesn't mean anything. What it means is these are firms with bad fundamentals, declining operating performance, high chance of going bankrupt, which are there, which are a part of high book to market universe. So it's important that you distinguish between these top quality and bottom quality firms. So as a starting point, what you can do is buy those stocks which score 9 and sell those stocks which score 0. Now, is there a huge difference between 9 and 8? Now, this is a qualitative judgment. What about firms which have 8? They are also good. 8 out of 9 parameters, they have done well. It's possible that one of the parameters it slipped because of some reason. So it's not a bad idea to actually include both 9 and 8 in your list of longs, and similar on the same argument, the company which has scored 1 out of 9, it's possible that by luck some one of the factors it has done well. So you can go short on that, 0 and 1. So another strategy could be go short on 9 and 8 and go long on 0 and 1. Now, where exactly to stop? Can we do 7, 8, 9, 0, 1, 2? Or can we do 6, 7, 8, 9, 0, 1, 2, 3, 4? This is a judgment call. And it crucially depends on the institutional setup in the country. So, I would recommend that you start with the strictest definition, which is 9 and 0, and maybe you go up to 9, 8 and 0, 1. And see the results yourself, and then think of changing your strategy. Because by doing so, you will be going long on high quality firms, going short on low quality firms. So why I am asking you to also consider 8? Because there may be very few firms at 9. Please remember, this is you are talking about high book to market universe. These are stocks valued very, very low. So unless we assume that investors in general misjudge a lot of stocks, it's unlikely that a lot of firms will get a score of 9. So you may not have enough stocks to trade. Remember this. Why are they valued low? These are firms with low analyst coverage, low liquidity, high chances of bankruptcy as well. So analysts generally don't follow them as much, and that is why market has neglected them. So now coming back, pick up these 9, 8 and 0, 1 firms and start trading. What do I mean by start trading? How do we trade? When do we trade? When do we buy? How long to hold? So that's what we will analyze next. Okay, let's do some bolts and nuts part of it, implementing the strategy. So far, so good. We have the score. We have categorized companies into 9, 8, 7, 6, 5, 4, 3, 2, 1, 0. And now we've decided that we're going to start going long on 9s and short the zeros. Or suppose 9s are very few in number. I already told you that it's unlikely that you'll find a large number of stocks which are valued low by the market. So if they are few in number, we'll do say 9, 8 and 0, 1. By the way, what's wrong with this trading few number of stocks? Suppose you have only say 4 stocks with 9. What's wrong with that? Nothing wrong, but that exposes you to idiosyncratic risk. Something wrong going on with the stocks. See, please remember, these are Petrosky scores is not a gospel of final truth. This is just a signal about likely health of the company. This is not that a certificate that company is going to do well. So it's quite possible that a particular firm does well in online parameters and some genuine unforeseen shock hits. Like we discussed in the other module, it's quite possible for a oil company which did very well up to say 2013 when oil was touching 100 and crossed up, or around 90s and 100s. suddenly the price falls 50%. The past fundamentals may be good, but that does not mean that your the future performance also is likely to be good. So if oil falls from 100 to 50, Petroski or no Petroski, there is no way the firm is going to do well. So if suppose you out of the 4 stocks that get a score of 9, if 3 are from oil, then your portfolio returns will get severely compromised. So you have to ensure that you have reasonable number of stocks and also they are sufficiently well diversified. You should ensure that these, so that is where skill comes. It's not mechanical application of Petroski. I want to re-emphasize again and again. This is very important. You can't just calculate, an Excel also can do it, or a computer can do it. You should exercise judgment here. You should look at this longs and shorts and you should ask yourself, is this sufficiently diversified? Do I have enough number of stocks? Am I exposing myself to some unforeseen risk? So that is why I am saying only 9s may not be a good strategy. If you have enough number of stocks, what do you mean by enough? Some say 30, 35, 40 now, 40 stocks with 10, 12 different industries. I think you are fine. You are doing okay, not bad. Otherwise, go to 8 or even 7 for that matter. Having now that you have chosen your longs and shorts portfolio, when to trade? That's the next question. And how long to hold? That's another question. And most importantly, when to close your trade? What do you mean by close your trade? Those which you have gone long, you will have to short, and those you have shorted, you will have to long, so that at the end of the period, you are back to 0. And the difference between all these 4 prices is your profit. Now when to trade is a question. First let's answer that. Can you guess when is the earliest you can trade? Pause for a while. I'll pause for a while. Of course, this medium does not allow me to wait for your answer and then tell you are right, you are wrong and all that. That's not possible. But I urge you to pause for a minute and think that when is that you can enter or start trading this strategy. By when I mean time of the year. I guess you would have thought about it. The earliest you can implement this strategy is when the financial statements are publicly made available. Remember this, none of our trading strategies are going to be based on private information. It is not that you have to know some director or some company official and get advanced information. All our strategies are based on publicly disclosed information, and therefore you will have to wait till this information is implemented. So even when you back test, this is very, very crucial, please note this. Even when you back test, you have to pretend as if you do not have information for a period, year end, until this results are disclosed. You have to pretend as if you don't have this information. What do I mean? Let me give a specific example. Let's assume that your year ending is December 31st. Right? Now you are doing a back test for, let's say, 2014. Now if you want to test that whether this particular strategy, need not necessarily be Petroski, it can be anything, has worked in the year 2014, you cannot assume that on January 1st you invested and held on for 3 months or 6 months, 9 months. Why? Because on January 1st you did not know the financial information. Year ends, board meeting happens, audit committee approves the numbers, then finally board approves the numbers, and then they are disclosed. And this process, depending on country to country, and this is where institutional framework is important. That's why I told you before that you should have a look at that part of institutional framework. And if you are trading in your home country, you will know all this. A reasonably educated person will have an idea as to how much time it takes between the end of a period and disclosure of results. So let's say we are in India right now. So in India, it takes around 2 months, 60 days. So even when you do your back test, you should factor this in. And for the December example that I was talking about, your trading should start on, say you leave out January and February, say March 1st. So if your strategy is to buy and hold for 3 months, you start on March 1st and hold for another 3 months, another 90 days. So this is very, very important. So when do you buy? It is immediately after public disclosure of information, right? So again, if we summarize, we know how to score, we know what to select, top and bottom, and now we have a reasonable idea when to buy. Done. Next, how long we should hold? That's another question. What should be the holding period? Now again, this will depend on your horizon. Maybe you are like a not so active investor. You may want to have a 1 year horizon. Petrosky tests 1 year horizon in his paper. Or you could even try 3 months or 1 month. I would suggest not less than 1 month because it's too short. Because remember, these are stocks which are chronically undervalued by markets. It will take time for markets to realize their value. And hence 1 month or 15 days may be too short a time. 1 month is still okay, 15 days or a week is, nothing is going to change in a week, This strategy will, I can almost guarantee you that 1 week holding period, this is not going to work. So 1 month is the least I can think of, but 3, 6, 9, 12, anything is fine. So decide on a holding period. When you do the back test, test different holding periods. So if you find that this strategy works only when you hold for 23 days, should you be happy that you found this 23-day magic number, or should you start worrying? Pause for a while and think. Suppose, let me rephrase my question if it is not that clear. What I am asking is, suppose this strategy, you do this back testing with different holding periods, 7 days, 15 days, 20 days, 1 month, 3 months, 6 months, so on and so forth. Suppose you find that only 23-day holding period works, gives you positive return. No other holding period works. Is it a good news or a bad news? It is a big bad news. There is something wrong. There is nothing economically significant about 23 days that it should work only for 23 days. This is where all these robustness tests come in. Of course, there is a possibility if there is a peculiar institutional feature applicable to that particular country where 23 days becomes important, then it's fine. Then you should know what that institutional feature is. Otherwise, the trading strategy should work for a range of days. I am fine with a strategy which works, let's say, between 25 and 40 days, but slows down after 40 days and doesn't work beyond 6 months, let's say, because all this gets priced in. That's fine. But what will worry me is that it works for 40 days, suddenly on 41st day it stops working. That's not a good sign. Right? So try various time intervals and decide on your holding period. Once you have decided on based on returns. So now you have the formula, you have longs and shorts, you have your timing of investment, and you have decided on your holding period. So this is all elements are done. Now what is the next step? No, not enough. You cannot just start investing right now. You will have to wait further. As I have suggested before, if you are a new trader, the first thing that you should do once you are equipped with this formula is to do mock trading. So there are number of platforms available in every country where you can keep generating your buys and sells, and using actual prices see how this trading strategy performs over a period of time. Give it a couple of years. There is no hurry. See for a couple of years how this particular strategy works. And two things may happen. One is, what are the two things in a trading strategy? You make money or you may not make money. Fair enough. But there is a third thing. You may, as you keep watching this, you may realize that some kind of tweaking, maybe you may realize that one signal is not informative at all. You may think that once you have delta ROA, ROA is not required. So that is the purpose of this course. You should be able to improvise, you should be able to tweak, you should be able to come out with a score keeping in spirit of Petrosky. You should be able to come out with your own formula that works in your market. So once you're confident that now you have a formula that works, once you're confident that once you figured out what are the ingredients of your formula, then only jump into the strategy. Then only start implementing the strategy and start buying and selling stocks. So that's about Petrosky. Thank you. Learning outcomes. After watching this video, you will be able to understand how to backtest a trading strategy. Alright, so we are now equipped fully to handle Petrosky formula, right? So given any company, you will create this F score, and you will find high performing companies, not so well performing companies, create this long short portfolio and trade. So that's what you are equipped with now. Now in implementation there may be a lot of issues. We have while we do back testing, we are going to do a separate module on back testing. We will take a strategy and tell you how actually to do back testing. As I've told you before, the approach here should be to reject a hypothesis, not to accept a hypothesis. So we are going to talk about it with one example. But when you back test, you don't face any restriction, right? You can trade any stock. You already know the prices. You can short anything, go long anything, because this is all imaginary. But in real life, there will be a lot of restrictions. For example, in many countries, shorting is not allowed. So Petrosky formula requires you to long the high performing companies 9, 8, whatever, and short the 0 and 1s or zeros at times. So if shorting is not allowed, how do you short zeros and 1s? So in such cases, or there are a lot of investors who are not comfortable going short. In fact, most investors are not, because that it doesn't come naturally, right? You can always think of buying something that you don't have, but it's very difficult to think of selling something you don't have. Assume that you have raised money from investors, you start a fund. A lot of people may not be comfortable with this whole concept of shorting. By the way, why do you need to short in this Petrosky formula? Because that to take away the directional risk, right? See, all that Petrosky says that within this universe of high book to market stocks that score higher are likely to do relatively better than stocks that score lower. Petrosky doesn't guarantee that the market itself is going to go up, right? What if you have a big market-wide event, an unforeseen market-wide event or an economic slowdown, that will pull every stock down. And that will of course pull down even the high Petrosky score stocks. So if you are long short, then you are protected from such downside market movement. Of course, you will have to lose some returns if the market is going to go up. For a long short investor, the focus is the gap between these potential winners and potential losers. Now coming back to this implementation issues, if your investors are not comfortable with this whole idea of shorting, it's not a bad idea to have a long only strategy where you just buy the top performing firms. However, you should tell the investor clearly that you are exposed to market risk. If the market goes down, then these stocks will go down. And also it's very, very important. In one of the modules we have already spoken about selection of benchmark. S&P 500 or a broad based index cannot be an appropriate benchmark for when these kind of strategies when you are doing long only. Why? Because you're trading in this high book to market form. So you have to choose appropriate benchmark which reflects the kind of companies that you're going to deal with, and then you can go with the long only strategy as well. You can just buy this 8s and 9s and hold it for 3 months, 6 months, 9 months, whatever your horizon is. Other constraint could be that shorting itself may not be allowed, then you don't have a choice. There are markets like India, we operate from India, so there are markets like India where shorting in spot markets is very difficult. You may have to use the derivative market, the futures and options market. If you are restricted to do that, then your universe gets restricted to stocks which are listed in the derivative segment. If a stock is not listed in the derivative segment, you cannot short it, hence you cannot use this long short strategy. So the bottom line is, you should consider the institutional realities of your economic setting where you are going to use this strategy and modify your strategy accordingly. And you can of course attempt a long only with high quality book to market forms, high book to market forms. So that ends Petrosky fully. We will now proceed to talk about post earnings announcement drift, another trading strategy.
Learning outcomes. After watching this video, you will be able to explain the importance of performance evaluation, describe the problem with using holding period returns to evaluate performance, calculate dollar and time weighted returns and discuss which is better. Measuring portfolio or fund returns. Until now, we have largely focused on the asset allocation and asset selection decisions. Say you are making your own investment decisions. How have your investments performed? Are you doing a good job of identifying profitable investment opportunities, or do you need to change your methods? Alternatively, you may have invested your wealth in a mutual or pension fund. From time to time, you would like to know how the fund manager has performed. Should your wealth continue to be invested in the same fund, or should you move your money to another fund? Even if the portfolio has performed well, the big question is if it has resulted from skill or sheer good luck. This is why performance evaluation is an important step in the entire investment process. However, there are two basic problems with performance analysis. One, we need to obtain many observations to achieve significant results. Two, shifting portfolio parameters like risk, covariance, etc. and style could make evaluation quite difficult. So we need to be very careful with how we measure portfolio performance. If the fund or portfolio doesn't have any new inflows or outflows, then it is easy to calculate its performance. It is simply its holding period return, which we have seen earlier. But in reality, investors are constantly investing and withdrawing money from the fund. This makes it really difficult to measure its performance. Let's look at an example to illustrate this. Say a fund's value is $200 million at the beginning of the quarter and its value is $220 million at the end of the quarter. A simple holding period return calculation would estimate its return to be 220 million over 200 million minus 1, which is 10%. But this ignores any fund flows during the quarter. For simplicity, let's say that the fund receives inflow of $40 million at the middle of the quarter. So it appears that a part of the increase in the fund value can be attributed to this inflow of $40 million. How do we now assess the fund's performance? It appears that 10% may overstate its true performance. One way to address this issue is to use dollar-weighted returns, or more generally, currency-weighted returns. Let's assume that every half a quarter is one period and R denotes the dollar-weighted return over this period. Then we have 200 million equals negative 40 million over 1 plus r plus 220 million over 1 plus r the whole squared. Solving for r, we get a negative 4.64%. Remember, this is the return over half a quarter. Over 1 quarter, the return would be negative 4.64 times 2, which is negative 9.28%. So once we adjust for inflows during the quarter, the fund has actually earned negative returns. An alternate is to use time-weighted returns to determine the fund's performance. Here, we calculate the fund's performance based on the fund value just before every flow. Continuing with our example, we need to know what the fund value was at the middle of the quarter just before it received an inflow of $40 million. Let's say that its value was $170 million. Right after the inflow of $40 million, its value goes from $170 million to $210 million. The fund's performance from the beginning of the quarter to just before the inflow of $40 million is 170 million over 200 million minus 1, which is negative 15%. Its performance from just after the inflow until the end of the quarter is 220 million over 210 million minus 1, which is 4.76%. The time-weighted return is simply compounding these two returns, that is 1 minus 0.15 times 1 plus 0.0476 minus 1, which is negative 10.95% over a quarter. This is slightly different from the dollar-weighted average return of negative 9.28% over a quarter that we calculated earlier. Dollar-weighted returns are usually influenced by the timing as well as the size of cash flows, whereas this is not the case for time-weighted returns. Hence, time-weighted return is generally preferred over dollar-weighted return. We have understood how to calculate the returns of a portfolio or fund. But is that return good or bad? In our example, the time-weighted return is negative 10.95% a quarter. Is it a bad return as it is negative? Not necessarily, because the rest of the market may have actually performed worse than this. So it is important to identify benchmarks that we can compare our portfolio's performance to. This is what we will look at next time. Learning outcomes. After watching this video, you will be able to discuss the need for risk-adjusted performance measures, list and calculate various risk-adjusted performance measures, list the circumstances under which you will use the various risk-adjusted performance measures. Benchmarks for portfolio performance evaluation. Investors should compare the returns of their investments to what they would have obtained from investing in an alternative portfolio with identical risk. Performance must always be evaluated on a relative basis and not on an absolute basis. However, it may be difficult to identify portfolios with identical risk, and so it is better to use risk-adjusted measures of performance. In this video, we will look at some commonly used risk-adjusted performance measures. The Sharpe ratio is one of the more widely used measures. It is similar to the Sharpe ratio we saw earlier. The Sharpe measure of a portfolio is the difference between its average return over the sample period minus the risk-free rate divided by the standard deviation of its returns over the sample period. It measures the return to total variability trade-off. If we believe that CAPM holds, then we know that returns compensate only systematic risk, while the Sharpe measure is based on total risk. The Trainer measure uses the CAPM beta as a measure of risk. It is the difference between the portfolio's average return over the sample period minus the risk-free rate divided by its beta. A drawback of both Sharpe and Trainer measures is that they don't quantify how much additional value the portfolio manager is adding. All they say is how much excess returns the portfolio has earned for each unit of risk. Hence, they can largely be used as a ranking criterion only. A measure that addresses this drawback is the Jensen measure or portfolio alpha. It quantifies the portfolio's average return in excess of that predicted by the CAPM. It tells us how far away from the security market line the asset is. Jensen's measure, denoted by alpha sub p, is the difference between the average portfolio returns minus, within square brackets, the risk-free rate plus the portfolio's beta times the difference between the average market returns and the risk-free rate. The term within the square brackets is CAPM's prediction of the portfolio's returns. A fourth risk-adjusted performance measure is the appraisal or information ratio. It is defined as the portfolio alpha or Jensen's measure divided by the diversifiable risk of the portfolio. This ratio gives us the abnormal return per unit of diversifiable risk. Let's look at an example that illustrates the use of these four risk-adjusted performance measures. We have two portfolios, P and Q. P has an average return of 35%, a beta of 1.2, standard deviation of returns of 42%, and diversifiable risk of 18%. Q has an average return of 28%, a beta of 1, standard deviation of returns of 30%, and diversifiable risk of 0%. The risk-free rate is 6%. We can say that Q is the market portfolio. Why is that? It has a beta of 1 and 0 diversifiable risk. Let's start off by calculating the Sharpe measure of P. It is 35% minus 6% divided by 42%, which is 0.69. Q has a Sharpe measure of 28% minus 6% divided by 30%, which comes out to 0.73. P's trainer measure is 35% minus 6% divided by 1.2, which is 24.17%. Q's trainer measure is 28% minus 6% divided by 1, which is 22%. P's alpha is 35% minus, within square brackets, 6% plus 1.2 times 28% minus 6%, which comes out to 2.6%. Since Q is a market portfolio, its alpha will be 0. Finally, P's appraisal ratio is its alpha 2.6% divided by its diversifiable risk of 18%, which gives us 0.14. Since Q's alpha is 0, its appraisal ratio is also 0. Looking at these values, the Sharpe measures say that P performed worse than Q, but the other measures say that it has performed better than Q. So which measure should we use to decide whether portfolio P has performed better or worse? The rule of thumb is as follows. If you have to decide on the portfolio manager's compensation, then use the Jensen's measure. It tells us how much value the manager has actually added. If you have to decide on optimal portfolio choices, use the Sharpe measure if the portfolio represents your entire investment. Use the trainer measure if the portfolio is one of many portfolios combined into a large fund. Use the appraisal ratio for actively managed funds that are held in combination with passively managed portfolios. There are still some drawbacks of using these risk-adjusted performance measures. 1, they rely on the validity of the CAPM. 2, they use a proxy for the true market portfolio rather than the true market portfolio itself. 3, they still cannot statistically distinguish skill from luck. We found that portfolio P's Sharpe measure was 0.04 lower than that of portfolio Q's. But we can't say if that is statistically a large difference or not, as this number is not a rate of return. Next time, we will look at a measure that helps address this last drawback. Learning outcomes. After watching this video, you will be able to calculate the M-squared measure, calculate the t-squared measure. Alternate performance measures. One of the drawbacks of risk-adjusted performance measures, as we saw last time, was their inability to say whether a difference in the measures is statistically significant or not. The m-squared measure, which is a variation of the Sharpe measure, will help address this drawback. To illustrate how to calculate the m-squared measure, let's use the same two portfolios P and Q from last time. You can see all the relevant values on the slide. The first step in calculating the m-squared measure is to determine what combination of P and the risk-free asset matches the total risk of the market index. In our example, P has a standard deviation of 42%, whereas the market index, which is portfolio Q, has a standard deviation of 30%. We are interested in combining P and the risk-free asset in such a way that it gives us a standard deviation of 30%. We know that the risk-free rate has no standard deviation and its covariance with P is 0. So we have the weight of P, W, times its standard deviation of 42% equals portfolio Q's standard deviation of 32%. This gives W to be 30% over 42%, which is 0.71. The remaining 1 minus 0.71, which is 0.29, is invested in the risk-free rate. A combination of 0.71 in P and 0.29 in the risk-free asset has the same standard deviation as portfolio Q's. Let's call this portfolio P star. What is the return of portfolio P star? It is 0.71 times 35% plus 0.29 times 6%, which is 26.59%. Portfolio Q has a return of 28%. The difference of 26.59% minus 28% is the m-squared measure. This comes to a negative 1.41%. Clearly, the difference in performance is substantial and cannot be ignored. There is also a similar measure analogous to the trainer measure. This is called the t-squared measure. To calculate the t-squared measure, we first need to combine portfolio P and the risk-free asset in such a way as to give a beta of 1. Calculate the return on this portfolio. The difference between this return and the market index return is the t-squared measure. What combination of portfolio P and the risk-free rate will give a beta of 1? Remember, the risk-free rate has a beta of 0. So we have the weight in portfolio P, W, times its beta of 1.2 equals 1, which gives us a W of 1 over 1.2, which is 0.83. The return of a portfolio of 0.83 in P and 0.17 in the risk-free asset, which we call portfolio P star, is 0.83 times 35% plus 0.17 times 6%, which equals 30.07%. Portfolio Q with a beta of 1 has a return of 30%. The t-squared measure is 30.07% minus 30%, which equals 0.07%. This tells us that portfolio P's performance is slightly better than the market portfolio Q. This wraps up the course on portfolio management. You have learned about developing your own investment philosophy. You have also learned about some of the important steps in the investment process, namely understanding your or your client's investment needs, the asset allocation and selection decisions, and finally, performance evaluation. I hope you enjoyed the course as much as I did bringing it to you. Goodbye.